Our next video lecture focused on how to prepare different types of financial statements. So what are these? These are reports prepared at the end of the accounting period that will tell us certain information about a business organization. There are four types of statements prepared by most corporations: the balance sheet, the income statement, the equity statement, which is also called the statement of retained earnings, and what's known as the statement of cash flows. For today, we're going to prepare the income statement first, followed by the retained earnings statement, which again, same with the equity statement, and the balance sheet. So you ready? Let's go. So what we have here is we have our company, and let me get up there to the top. One second, let me change my view for you. I was already prepared. Unfreeze for a second. Okay, so we have the Nimbus Flying School. This company provides flying lessons. And they were started with investment by the owners in the amount of $45,000 in cash. Now that's important, and we're going to use that information to prepare these statements. Next, you have the different accounts, and these are the account balances as of the end of the month of May. They said that there were no more investments made by the owner in the month of May, but they did pay out dividends in the amount of $500 during the month of May. Our goals: prepare an income statement, a retained earnings statement, as well as a balance sheet. Okay? We're going to begin to prepare what's known as an income statement. The income statement is also referred to as a profit and loss statement. This statement shows a company's profit or their loss over a specified period of time. We're preparing the statement for this corporation for the month of May. So for this month, we're going to indicate whether they had a profit or a loss during the month of May. You must know what type of accounts are going to appear on these different types of financial statements. The income statement only consists of revenue accounts and expense accounts. Again, the income statement only consists of revenue accounts and expense accounts. Our goal again is to determine whether we had a profit or a loss for the specified time period. For any statement, your heading goes first. That's the who, the what, and the when. It shows the name of the company, the type of statement, and the time period being covered by the financial statement. So we have Nimbus Flying School income statement for the month ended May 31st, 2018. First, we're going to list the different revenue accounts that took place during the month of May. So look at all of your account titles and ask yourself which of these are revenue accounts. We only have one, service revenue, which I put on the income statement already, and the amount of service revenue was $6,800. So I'm going to record that amount, $6,800, as revenue on my income statement. So revenue shows the money earned by the company either from providing services or from the actual sale of products. Because this is a service-based organization, we have an account title called service revenue. Next, we look at what type of expenses took place in order to earn revenue for this business organization. You've heard the phrase, in order to make some money, you must do what? Spend some money. That's correct. So we look at all the expenses that took place during the month of May. There was advertising expense, rent expense, maintenance and repair expense, gasoline expense, as well as utilities. So we're going to list all the expense account titles on the income statement and the amount for those expenses, okay? So the advertised expense total 500, not 50, 500. The rent expense total 900. The maintenance and repair expense was 350. Gasoline expense was 2,500. Utility expense total $400. You're going to itemize, list all the expense account titles. Then you get a total for all of the expenses. They total $4,650. We next want to determine whether we have what's known as a net income or a profit for the accounting period, or what's known as a net loss. To determine that, subtract total expenses from your total revenue. Again, subtract total expenses from your total revenue. If this number is positive, which it is in our situation, it means we earn a profit, which is known as net income. So get rid of that. So we've earned a net income in the amount of $2,150. But what if by chance the expenses were more than the revenue? Then you will have a negative number, which is known as a net loss. So on your income statement, you're going to either have a net income or a net loss for each accounting period. We've earned net income for $2,150. Congratulations, you've now completed the first statement known as the income statement. The next statement is called the retained earnings statement. The word retain means to keep. What are you keeping? Your earnings. So this statement shows what portion of the company profit has been kept by the company and not paid out as dividends to the actual stockholders. So again, you have your heading first. That's your who, what, and when, the name of the company, the type of statement, and the time period being covered by the statement. Your first line item is called beginning retained earnings. This shows the amount of earnings that have been retained by the company at the beginning of the accounting period. Now remember that this company just started in the month of May. So we're a brand new company. So our beginning retained earnings is going to be 0 because this is our first month of operations. Next, you're going to either add your net income to this statement or subtract out your net loss. That information is coming from your income statement. The income statement shows whether we had a net income or a net loss for the accounting period. For our example, we had net income for $2,150. Therefore, the net income amount is transferred over to our statement of retained earnings. Next line item will be dividends. Recall that dividends are payments made to the stockholders. When you pay out dividends, that is money being taken away from the business organization. We paid out dividends this month in the amount of $500. Because it's a payment, put it in as a negative number, because when you pay out a dividend, it is going to reduce the amount of your retained earnings. Our beginning balance was 0. We earned net income for $2,150. We paid out $500 in dividends. Therefore, our ending retained earnings is $1,650. 2 statements down, 1 to go. Our last statement is known as the balance sheet. The balance sheet is a snapshot of the company's accounting equation. The balance sheet shows each account balance as of a specific date. Notice For the first two statements, they say for the month ended on the income statement and retained earnings statement. The balance sheet shows a specific date. These are the account balances on May 31st of 2018. The balance sheet has three categories: assets, liabilities, and stockholders' equity. These are the same three categories listed on the accounting equation. We'll first begin with our asset category. So now I'm going to do a little change in the view. Your job is to understand, first, which of these accounts qualify as being asset accounts. So you have a list of account titles shown here. You must know which of these accounts qualify as being asset. Remember that assets are things of value that are owned or controlled by the business organization. So for assets, we have cash, account receivable, and equipment. Those are all considered to be asset accounts. They're all items of value that are either owned or controlled by the business organization. So my cash amount is $4,650. Account receivable $7,400. The equipment total $64,000. So itemize, list all of the asset account titles, and they get a total of all of our assets. Our assets total $76,050. The next section, you have your liability section. And again, liability refers to the existing debts or obligations of the business organization. So look at the account title. We're saying which of these qualify as being liabilities. As a hint, your liability accounts, for the most part, will always end in the word payable because we owe someone. So we have accounts payable, and we also have notes payable. The accounts payable total $1,400. Notes payable total $28,000. Get a total of your liabilities. They total $29,400. Each category on the balance sheet must have a total for your assets, a total for your liabilities. Our last category is known as stockholders' equity. There are two components that make up stockholders' equity, what's called common stock and retained earnings. So here, when the owner made an investment into the business for $45,000, in exchange for that cash they would receive what's known as common stock. That amount was $45,000. I'm going to record that in the equity section of my balance sheet. We're saying, what is the amount of retained earnings at the end of the accounting period? That amount is coming from here, from the retained earnings statement. The ending balance was $1,650. The ending balance is transferred from the retained earnings statement to the balance sheet. So record that $1,650 in the retained earnings. Get a total for my equity section. It totals $46,650. Now the balance sheet must do what? You got it, it must balance. So my liabilities and my equity together must equal my total assets, and they do. Both sections total $76,050. Congratulations, you have now just completed your first set of financial statements.